Hey everyone, welcome to the blockchain and cryptocurrency course. In this video tutorial, we will be learning about Bitcoin, in which we will be covering what is Bitcoin, history of Bitcoin and how Bitcoin is different from traditional cryptocurrencies. So without wasting time, let's jump into Bitcoin. First of all, what is Bitcoin? Bitcoin uses peer-to-peer technology to operate with no central authorities or banks. Managing transactions and issuing of Bitcoin is carried out collectively by the network. Bitcoin is open source. Its design is public. Nobody owns or controls Bitcoin and everyone can take part. Through many of its unique properties, Bitcoin allows exciting uses that could not be covered by any previous payment system. A pseudonymous software developer going by the name of Satoshi Nakamoto proposed Bitcoin in 2008 as an electronic payment system based on mathematical proof. The idea was to produce a means of exchange independent of any central authority that could be transferred electronically in a secure, verifiable and immutable way. History of Bitcoin. The idea of having a digital currency is not new one. Prior to cryptocurrency, many attempts have been made. The main issue most of them were facing was the double spending problem. A digital asset somehow needs to be usable only once to prevent copying it. Over the 10 years before cryptocurrency, the concept had been introduced by computer engineer Y-Dai in 1998. He published a paper where he discussed B-money. He discussed the idea of digital currency which could be sent along the group of untraceable digital pseudonyms. That same year, another attempt by the name of BitGold was drafted by blockchain pioneer Nick Szabó. BitGold equally looked into creating a decentralized digital currency. Szabó's idea was spurred by inefficiency within the traditional financial system, such as requiring metal to create coins and to reduce the amount of trust needed to create a transaction. While both were never officially launched, they were part of the inspiration behind the Bitcoin. In 2008, a paper called Bitcoin, a peer-to-peer electronic cash system, was posted to a mailing list discussion on cryptography. It was posted by someone called Satoshi Nakamoto, whose real name identity remains a mystery to this day. In 2009, the Bitcoin software made available to the public for the first time, and mining, the process through which new Bitcoins are created and transactions are recorded and verified on the blockchain, begins. In 2010, Bitcoin is valued for the first time as it had never been traded, only mined. It was impossible to assign a monetary value to the units of emerging cryptocurrency. In 2010, someone decided to sell there for the first time, swapping 10,000 Bitcoin for 2 pizzas. If the buyer had hung onto these Bitcoins at today's price, they would be worth more than $100 million. In 2011, Bitcoin's rival cryptocurrency emerged. As the Bitcoin increases in popularity and the idea of decentralized and encrypted currency catch on, the first alternative currencies appear. These are sometimes known as altcoin and generally try to improve on the original Bitcoin design by offering greater speed, anonymity or some other advantage. Among the first to emerge were Namecoin and Litecoin. Currently there are over 1000 cryptocurrency in circulation with new ones. 2013, Bitcoin price crashes shortly after the price of 1 Bitcoin reaches $1,000 for the first time. The price quickly begins to decline. Many who invested money at this point will have suffered losses as price plunged to around $300. It would be more than 2 years before it reaches $1,000 again. 2016, a year of Ethereum and ICO. One cryptocurrency came close to stealing Bitcoin's thunder this year. An enthusiasm grew around the Ethereum platform. This platform uses cryptocurrency known as Ether to facilitate blockchain-based smart contracts and applications. Ethereum's arrival was marked by emergence of initial coin offering called ICOs. These are fundraising platforms which offer investors the chance to trade what are often essentially stocks or shares in startup ventures. In the same manner that they can invest and trade cryptocurrency, in the US the SEC warned investors that due to the lack of oversight, ICOs could easily be scams or Ponzi schemes disguised as legitimate investments. The Chinese government went one step further by banning them outright. In 2017-19, a gradual increase in the place where Bitcoin could be spent contributed to its continued growth in popularity during a period where its value remained below previous peaks. Gradually, as more and more usage emerged, it became clear that more and more money was flowing into Bitcoin and cryptocoin ecosystem. During this period, the market cap of all crypto coin rose from 11 billion to its height of over $300 billion. In 2017, banks include Barclays, Citibank, Deutsche Bank, BNP Paribas have said that they are investigating ways they might be able to work with Bitcoin. Meanwhile, the technology behind Bitcoin has sparked a revolution in fintech industry, and which is only just getting started. In start of 2018, Bitcoin started declining and it went to $3,000, and again it rose to $14,000 in July of 2019. So Bitcoin is here for long. So does the technology behind it. Bitcoin can be used to pay for things electronically. If both parties are willing, in that sense, it's like conventional dollars, euros or yen or Indian rupees, which are also traded digitally. But it differs from fiat digital currency in several important ways. First is decentralization. Bitcoin's most important characteristic is that it is decentralized. No single institution controls the Bitcoin and Bitcoin network. It is maintained by a group of volunteer coders and run by open network of dedicated computers spread around the world. These attracts individuals and groups that are incompatible with control that banks and government institutions have over their money. Bitcoin solves the double spending problem of electronic currencies through an ingenious combination of cryptography and economic incentives in electronic fiat currencies. This function is fulfilled by banks, which gives them control over the traditional system. With Bitcoin, the integrity of transaction is maintained by distributed and open network owned by no one. Limited supply. Fiat currency have an unlimited supply. Central banks can issue as many as they want and can attempt to manipulate currency's value relative to others. Holders of the currency bears the cost. With Bitcoin, on the other hand, the supply is tightly controlled by underlying algorithm. A small number of Bitcoin trickle out every year and will continue to do so, diminishing rate until maximum of 21 million has been reached. This makes Bitcoin more and more attractive as an asset. In theory, if demand grows and the supply remains the same, the value will ultimately increase. Pseudonymity. While senders of traditional electronic payments are usually identified, users of Bitcoin in theory operate in semi-anonymity. Since there are no central validator, users don't need to identify themselves when they are sending Bitcoin to another user. When transaction request is submitted, the protocol checks all previous transactions to confirm that sender has necessary Bitcoin as well as authority to send them. The system doesn't need to know his or her identity. In practice, each user is identified by address of his or her wallet. Transaction can with some effort be tracked this way. Also, law enforcement has been developed method. Furthermore, most exchanges are required by law to perform identity checks on their customer before they are allowed to buy or sell Bitcoin, facilitating another way that Bitcoin usage can be tracked. Since the network is transparent, the progress of particular transaction is visible to all. This makes Bitcoin an ideal currency for criminals, terrorists, or money launderers. Immutability. Bitcoin transaction cannot be reversed, unlike electronic fiat transactions. This is because there is no central adjudicator that can say, okay, return the money. If the transaction is recorded on the network and if more than an hour has passed, it is impossible to modify. While this may disquiet some, it does mean that any transaction on the network cannot be tampered with. Divisibility. The smallest unit of Bitcoin is called Satoshi. It is 100 millionth of Bitcoin. At today's prices, about 1/100th of a cent. This could conceivably enable microtransactions that traditional electronic money cannot. So folks, this was all about Bitcoin. Let's quickly revise what you have learned in this tutorial. We have learned what is Bitcoin, brief history of Bitcoin, and how Bitcoin is different from traditional cryptocurrencies. So folks, this was all about application of blockchain. Stay tuned for more about blockchain. Thank you very much.